In the late 1800s and early 1900s, enormous fortunes existed largely on paper. Railroad stock, steel shares, oil trusts, holding companies, and bank issued securities. Industrialists weren't walking around with cash. Their wealth existed as equity, ownership in corporations whose value depended on infrastructure, patents, and market dominance. When people talk about Titanic era elites, they're talking about men whose wealth was tied to corporate paper and not vaults of gold. Figures like J.P. Morgan, Andrew Carnegie, and Rockefeller interests were operating through layered institutions. Their wealth structures were not dependent on one voyage. By the early 1900s, American industrial capitalism had matured beyond personality driven control. The Interstate Commerce Act of 1887 was one of the first attempts to regulate railroad monopolies, but for decades, industrial expansion outpaced regulation. Railroads connected national markets, steel production scaled, oil distribution standardized. Transportation law and corporate expansion allowed companies to operate across state lines more easily. That scale amplified profits, and profits compounded. The 16th Amendment was ratified in 1913, establishing a permanent federal income tax. Before that, large fortunes could accumulate with relatively little federal taxation. After 1913, and especially during World War I, top tax rates increased significantly. That shift changed the pace of billionaire creation. The first billionaires emerged before progressive taxation and strong antitrust enforcement were fully active. Legal environment matters.